bull call spread is a versatile multi-leg option strategy, empowering investors to capitalize on anticipated stock price increases while benefiting from rising volatility. Let's explore this strategy in depth so you can grasp when, why, and how to use the spread effectively. This strategy can be an alternative to single leg approaches like the covered call and the long call often employed by traders. The covered call strategy involves purchasing shares of stock and selling a call at a specific strike price to collect a premium. The strategy includes the capital cost of owning 100 shares of stock for each call contract sold. The bull call spread addresses this challenge by utilizing a long call instead of owning stock shares. The call typically requires less capital than buying shares, and the rate of return on the investment will be higher. Some traders favor using long calls to attempt to profit from rising stock prices. They are drawn to the prospect of unlimited potential profits with limited risk. But stock prices do not rise forever. They may often stall at resistance or even change trend direction before the trade is ended. Using a bull call spread may help lower trading costs while managing risk, even though the spread does cap potential profits. This strategy is suited for situations where you are moderately bullish about a stock's price, anticipating a rise but only up to a nearby resistance level. You can use TradeStation's radar screen and scanner to identify bullish stocks based on specific criteria. Here's an example. In this TradeStation scanner, we are filtering all listed stocks using percent change, average volume, a specific price range, and RSI values at different time frames to identify potentially bullish stocks that may pull back in price toward its support level. The results from the scan may be candidates for a bull call spread strategy. The sample scan and the workspace featured in this video are available for TradeStation clients to download. To monitor the scanner results in real time, let's transfer the symbols from scanner to radar screen using copy and paste. Once in radar screen, we can rank symbols and select stocks with higher open interest. In this example, let's pick the stock with the highest open interest since it may be presenting a timely opportunity. To implement a bull call spread on TradeStation, first launch OptionStation Pro and load options chains for our selected symbol. There are multiple methods to build a bull call spread, and we'll use a straightforward approach to add legs individually. Given that time decay impacts a position, opt for expirations over 60 days to avoid significant decay. Time decay on options is not linear. It begins with minimal impact on the option's value and grows more significant as time passes. As the option approaches expiration, particularly in the last 30 days, the impact of time decay accelerates exponentially. To avoid this, consider closing the position approximately 30 days before the option's expiration. Selecting the long call strike is crucial as it determines the position's risk, with the premium paid representing the potential loss. The premium collected from the short call offsets some of the long call's cost. The long call also drives the spread's profit, gaining value from the underlying price rise or increased volatility. The closer the strike is to the underlying price, the higher the premium paid, but it also increases the probability of the option finishing in the money. While deep out of the money calls provide a lower premium, they require a more substantial price movement for profitability, therefore lowering the likelihood of the spread yielding a profit. Let's choose a strike near the current underlying price for our bull call spread. Choosing the right strike is vital. A strike near a support level where prices are expected to bounce can also be a strategic move. However, timing the entry to coincide with the underlying price at or bouncing from the support level is crucial. Entering the spread prematurely, such as before the price descends to the support level, may result in a drawdown for the position until the underlying price bounces. To select the long call, click on its ask price. The call's option row is highlighted in blue and is added to the trade bar below. Once the long call is selected, a higher strike call is sold simultaneously to create the spread. Choose a strike to maximize premium collection while ensuring it remains sufficiently distant from the long strike to allow for potential profit. Hold the Control key on the keyboard and click the call's bid price to add the short leg to our spread. The short calls row is highlighted in red and added to the trade bar below. The vertical line next to the strike prices changes to green for profits and red for losses, reflecting the impact of the underlying price movements. The point where the line shifts color represents the break-even, calculated as the lower strike plus the premium paid. The trade bar displays the spread as a vertical, indicating key parameters such as max profit and max loss. While selecting a price between the bid and ask by clicking the mid button may offer better pricing, let's opt for the natural option. This will populate the price box with the actual buying and selling prices of the calls in our spread, improving our chances of getting filled. Review the order details and click Place Order to send it to the market. Confirm the order and monitor its position on the Manage tab. Right-click on the open order if you wish to cancel or replace it. Once filled, the individual legs will appear in the Positions panel below. Drag and drop one leg onto the other to group them as a spread. Right-click on the spread and select Close Position if you wish to set a profit target or a stop loss on the position. In summary, the bull call spread is a multi-leg strategy designed to capitalize on anticipated stock increases while managing risk. This involves buying a call option and simultaneously selling a higher strike call. The strategy thrives on heightened volatility and upward movements in the underlying price. While offering limited potential rewards and losses, it demands precise strike selection and vigilant trade monitoring. Traders typically opt to close the spread before options expiration to mitigate the impact of time decay. Before trading, practice in simulated trading mode on TradeStation to build confidence without real financial exposure. Access the downloadable Workspace and instructional PDF, guiding you on utilizing scanner and radar screen to identify bullish setups, and learn how to integrate OptionStation Pro for effective bull call spread trading. Explore additional training and elevate your skills by tapping into the comprehensive resources within this option series.